Ever wondered if the stock market could suddenly change and affect your money? Well, you're not alone. In this video, we're diving into a fascinating idea. Could the stock market flip in 2023? But before we explore this, make sure to give us a thumbs up, subscribe to our channel, and click the notification bell. This way, you'll stay updated with the latest info that could help you make smart financial decisions. Now, let's talk about why the stock market might be about to change and what you should know. Now, before we delve deeper into the question of whether the stock market is about to flip in 2023, let's clarify what we mean by a flip in the stock market. In the context of the stock market, a flip refers to a significant and often sudden change in the direction or trend of the market. It's essentially a transition from one prevailing market condition to another, typically characterized by a shift in investor sentiment, economic factors, or other catalysts. This change can be in various forms, such as a bull market flipping to a bear market or a dominant sector losing its prominence to another. A flip can have a substantial impact on investment strategies and decisions. Now that we know the meaning of flip, let's take a deeper look at the stock market growth in 2023. In 2023, the stock market is undergoing a transformative phase that merits closer examination. At the heart of this transformation is a remarkable trend where only a handful of sectors are playing a pivotal role in driving the majority of the stock market's growth. These influential sectors can be identified as information technology, communication services, and consumer discretionary. A prime illustration of this phenomenon can be found in the performance of the VOO ETF. This exchange-traded fund, representing the top 500 companies in the United States, holds substantial positions in tech giants like Amazon, Meta, and Microsoft. Astonishingly, the VOO ETF has exhibited a remarkable 12.5% increase in value within the current year. This exceptional performance has defied prior predictions made by financial analysts, who, towards the end of the previous year, foresaw a lackluster stock market during the initial half of 2023. The underlying reason for this unexpected growth can be traced to three distinct tech rallies that unfolded throughout the year. First, there was the January effect, characterized by a surge in the performance of previously underperforming stocks from the prior year. Following this was a significant shift of capital from the financial sectors into the thriving tech industry. Finally, an AI, artificial intelligence boom further accelerated the growth of the tech sector. Despite these positive developments, it's worth noting that many investors initially underestimated these trends due to widespread pessimism. This underestimation resulted in the tech sector's dominance in the current landscape. In fact, 7 prominent technology giants now account for a significant proportion of the stock market's growth in 2023, emphasizing the tech sector's commanding position. However, the dominance of the tech sector isn't the whole story. While tech stocks are soaring to new heights, the performance of many non-tech stocks paints a different picture. On average, these non-tech stocks have experienced a 1.2% decrease in value this year. This striking divergence between the tech sector's exuberance and the rest of the market's struggles presents an intriguing dynamic. Moreover, this divergence can be viewed as an opportunity for undervalued sectors to regain lost ground and potentially contribute to the overall growth of the market. Historical data lends credence to this idea, as it suggests that when only a few stocks outperform the S&P 500 to such an extent as witnessed in 2023, it often leads to an upward trajectory in the broader market. Thus, while the current market landscape appears somewhat lopsided, it simultaneously offers the prospect of equilibrium and growth as other sectors aim to re-establish their influence. In conclusion, the stock market in 2023 is characterized by fascinating dynamics, with a concentration of growth in specific sectors and the potential for broader market rejuvenation. The interplay between these factors offer both seasoned and novice investors an intriguing and evolving landscape to navigate. Before we continue with more insights, take a quick moment to show your support by giving this video a thumbs up and subscribing to our channel. Your support keeps us going, and we truly appreciate it. Now, back to the exciting content. Broader stock market trends in 2023, the potential flip. Beyond the specific focus on stock market growth in 2023, there's a more profound narrative at play, suggesting that the entire stock market is on the cusp of a potential transformation. This narrative centers on the critical factor of interest rates and how they could reshape the stock market landscape in the coming months. Historical patterns and data analysis indicate that after a series of rate hikes, the S&P 500 has historically shown robust growth in the year following the conclusion of the rate hike cycle. It's this historical precedent that has captured the attention of investors and market analysts alike. Specifically, the focus is on the 12 months that follow the end of a rate hike cycle, which often sets the stage for market dynamics. The rationale behind this intriguing phenomenon is rooted in the impact of interest rates on the broader economy. When interest rates are high, borrowing becomes more expensive, which tends to discourage borrowing and spending. This, in turn, can lead to slower economic growth. However, if the Federal Reserve, the central bank of the United States, decides to pause its rate hikes, as it might in the upcoming weeks, it could eventually pave the way for rate decreases. These rate decreases can stimulate borrowing and spending, thereby fueling economic expansion. This pattern of events has been observed since 1990, where historical data shows that after a pause in interest rate hikes, the Federal Reserve typically takes around 10 months before initiating a rate cut cycle. Market participants are closely watching this scenario, anticipating that a potential pause in interest rate hikes could pave the way for lower interest rates within the next 10 months. Now, let's explore why this narrative suggests that the stock market is about to flip. The hypothesis is that if the Federal Reserve indeed decides to pause its rate hikes and subsequently starts lowering interest rates, it could set in motion a chain of events that significantly impacts the stock market's trajectory. When interest rates are high, they can act as a headwind for stocks because they make alternative investments, such as bonds, more attractive, potentially diverting funds away from equities. However, if interest rates begin to decline, stocks could become more appealing to investors seeking higher returns. Furthermore, a drop in interest rates can lead to decreased borrowing costs for corporations, which could boost their profitability and consequently their stock prices. Additionally, lower rates can encourage consumer spending, potentially benefiting companies in various sectors. In essence, the theory is that the stock market is poised for transformation because it is anticipating that the Federal Reserve's potential pause in rate hikes and subsequent rate decreases might create more favorable conditions for equities. This expectation aligns with historical trends, where a change in the interest rate environment has often correlated with shifts in stock market performance. However, it's important to underscore that market predictions and reality can sometimes diverge, and there are no certainties in financial markets. The stock market's reaction to interest rate changes may not unfold precisely as expected. Nevertheless, this narrative has ignited speculation that the stock market is at a pivotal juncture, ready to respond to shifts in the broader economic landscape. In summary, the narrative of a potential flip in the stock market in 2023 revolves around the dynamic relationship between interest rates and equities. The anticipation is that a pause in rate hikes and the subsequent decline in interest rates could provide favorable conditions for stock market growth. This theory is grounded in historical patterns but is subject to the complex and dynamic nature of financial markets. As such, it remains a compelling story to watch unfold in the coming months. And that's a wrap on today's video. We hope you learned something. If you had a good time with us today and found this video informative, don't forget to show your support by hitting that like button and subscribing to our channel. And of course, turn on the notification bell so you never miss our exciting updates. Now, here's a question for you. What are your thoughts on the stock market in 2023? Will it flip or stay the same? Share your answer in the comments below. Thanks for joining us on this financial adventure. and we can't wait to hear your thoughts. See you in the next video.